Uh, Today what we are going to do is we are going to discuss the rest part of the chapter, becoming an associate after acquiring an ownership interest. Now, just focus on this, just read this. Take a few times and read this. Okay. In certain cases, even though you are getting a 20% ownership, you may not get the significant influence. That means you don't have opportunity to participate in the policy making, you know, operating and financial decision making process. You don't have an opportunity to participate in the board of director boards. You don't have any, you know, material transaction. You are not providing any technical assistance. There are no related massive related part transaction. If that is the case, we know that even though you have 20%, you don't have the significant influence. We can't make that assumption. But later, read this example. For example, assume Star Limited acquired 20% ownership on first, but because of the particular distribution of balance of voting power, CETA Limited did not significantly influence the decision of. They don't have the significant influence balance just because of the ownership structure. But on 2017 January, as a result of sales of certain large shareholding, another shareholder is disposing their investment. The new company, CETA Limited, was able to get the significant influence. Now, when you look at the substance over form, the reality, actually, even though you have the ownership from this date onwards, you are getting the significant influence on this date. So thereby, equity method be adopted with effect from this date, not the ownership date. That's the point. Even though you are getting the 20% ownership, if you don't get the significant influence, you know the meaning of significant influence. That is your power to participate in financial and operating policy decisions. The example, whether the significant influence is there or not, we can have symptoms. For example, you are there in the board, director board, and you are providing technical service to the investee, and you have significant related part transactions, or you may provide the management services for them. So then you have the significant influence. What I want to communicate to you is that by using this particular heading, of course, equity method should be adopted by when preparing consolidated financial statement at the time you receive the significant influence. So thereby, the ownership date is not relevant here. What is relevant here is at which point you receive the significant influence. And and I will read that. I'll communicate the rest part of the matter. Shall we just focus on the example? Assume C acquired 20%, 1st January 2017. This is the value. 1st January, beginning of the 2017. And as per the question, you are getting the significant influence on this date. Is it? Beginning of time. 1st July 2007 at the fair value, investor measured the fair value identifier assets. Yes, here. Significant influence is on this date. 2017, July 1st. That means after 6 months. Acquisition date is 1st January 2017. After 6 months, only you get the significant influence. But you have to remember, investment you made at the beginning of the 2017, that is 27,500. But at this time, you have to account for this investment, not under equity method. So we have to find out what method you have used to account for. And you will see here, Horn Limited was initially measured at 27,500 with movements in fair value being recognized in profit and loss for the period. So thereby, what you have done is the 6-month period, you have considered this investment as financial assets through profit and loss. So thereby, you record the fair value. So thereby, what you have to do is, when you look at the data, first, of course, this is the fair value, and we have to find out the fair value as at this date. So I think as per the question, fair value is 28,000. What you have to do is the difference. You can remember the difference we recognize as income in the gain on investment in the P&L. Okay. At this date, the investor measure fair value identifiable assets and liabilities 138. So the net assets acquired so much at fair value. So thereby you take 20% out of that. Net assets acquired is so much, 27,600, and the investment is 28, not the 27,500. You have to remember that. We are not taking the initial cost in such situation. We will take the fair value at significant influence point. So thereby fair value at significant influence point is not 27,500. It is given 28,000. So thereby, as purchase consideration to calculate the goodwill, we take 28,000, not the 27,500. So thereby goodwill is 400. And C Limited would apply equity method investment from blah blah, and assume that H Horn Limited, that is the investee, 10,000 profit for the 6 month. The 6-month period. If I am drawing a picture, I think you can remember the dates. Now it's something like this. We have the dates. This is the acquisition date. Acquisition date is 1/1/2017. Okay, can you remember the acquisition date? There you buy it at 27,500, 27,000.5, right? Is the, and this point you get the significant influence, that is 1/7/2017, significant influence 2017, right? And our financial period ending 31st December 2017. Okay. Now what I want to communicate to you is that we can't account for this investment in the books of C. We are talking about keeping books in the C, consolidated financial statement. We can't consider this period as significant influence. We consider it as a normal investment, financial assets. As per the question, it has been treated profit and loss, the difference, fair value, financial assets through profit and loss. And this point, this 27,500 has become 28,000. That is the fair value. So you had this carrying value initially. At this date, you have this value. So the difference is really 500, you have to consider it as income. I will discuss that one later on. 500, okay, that is the gain on investment. From this date onwards, you consider the investment as, you know, an associate. So you have the investor and associate relationship. You are the investor, you have purchased 20%. 6 months later, you received you got the what do you call significant influence power. From that point, you have to account under the equity method. And during this period, profit is given. During this period, profit is 10,000. Profit is 10,000. Profit is 10,000. So how do you do? Under equity method, you have 28,000 in the books, 28, right? And your share of profit, no tax. I don't think any tax matter is given. We assume this is the post tax. So thereby here 20% means 2,000. That is 30,000 is the equity method value. So we will look at the journal entries. Journal entries would be the difference. I think you can remember investment in Horn, that is the 27,005.5. You debit that account 500. That means you are making the investment amount account, the carrying value of the investment account 28,000. You are converting 27.5 to 28. And income gain on investment is 500. That is credited to the P&L. That is credited to the P&L. Okay. You can read the narration. That now your investment account is not the 27.5. Now it is 28. And another inventory, now you label it as investment in associate. Now here you didn't mention it investment in associate because at that time it was not the associate. You didn't have the significant influence. So thereby you will see the name of the account, here the name of the account. And what I want to communicate, the share of profit is investment in associate debit, share of profit and loss associates is 2,000. Altogether, balance sheet value has to be your balance sheet value, the amount which has to be shown in the balance sheet as at this date, as at this date, 31st December 2017 is 30,000. For the period, we are showing a profit item as 2,000. That's all. I hope you got it. Okay, we will go to the next one. That is about acquiring. You acquire the 20% or more than 20%, but you didn't get the significant influence due to, you know, structure of the other investments, due to other factors. You are not getting the significant influence. You get the significant influence later. So at that point only you can start accounting for equity method. Okay, so there you have to do two things. One is the initial investment, you have to bring it to the fair value, and the difference between carrying value and the new fair value, you charge the income statement as gain on investment, maybe a loss or maybe a gain, depend on the situation. Second point is you have to take only the profit share of that particular period, not the full period. Is it clear? Okay. Then again, we will just applying the applying the equity method intercompany transactions. Transaction between investor and associates we talk about. Now, basically, when you look at the transactions, here it is not like consolidated the transaction, intercompany transaction between the parent and subsidiary, you have done it, but similar, but there is a slight difference. You have to understand that difference. Okay, when you do transactions, there are two things. One is upstream and other one is downstream. You have to understand this, what is upstream and downstream. When you say upstream, this is the idea. Upstream transactions are, for example, sale of assets from an associate or a joint venture to the investor. That means when you say upstream, means from investee to the investor, from associate to the investor. You are the associate, and you are selling goods to the investor. You are selling goods to the investor. That is called upstream. The opposite idea is called downstream. That means investor is selling items to the associate. Investor is selling to the investee or the associate. I think you can understand what is downstream and upstream. Okay. What is here is the investors share in the associates of or joint venture gain or losses resulting from these transactions is eliminated. We only consider unrealized profit, not the full, the portion of the investor. I think that's the main item which I want to communicate here. But we will take one example. If you want, you can read all this material. Main idea is that you take only the share profit or loss, associate and joint venture, right? Yes. I think better take one example, then you can understand what it is. Okay, we will take this example. Inter-entity transactions. In the following example, assume that the reporting period is the year ending 30th June 2017, that the investor Saxophone S Limited owns 25 of Basen Limited. Basen Limited is considered to be either an associate or joint venture of S Limited. So Basen is the investee. Basen is the investee. Basen is the investee. Other S Company Limited is the investor. Okay. S acquired its ownership interest in P 1st July 2015 when the retained earning balance was B Limited was 100,000. At this date, all the identifiable assets and liabilities B Limited were recorded at fair value. At 30th June 2016, the retained earning balance B 140 and the net profit recorded for 2016 to 17 period is 30,000. The tax rate is 30%. 2015 to 16 period, and you have to understand 2016 to and 17 period. There are two accounting period here in this case. Okay. The adjustments entries may differ accounting to whether they are made in the consolidated worksheets in accounting records of the investor, in the accounting records of the investor. Differences in particular arise where the effects of transaction occur across 2 or more years. Now you can understand this. The acquisition is 25% on this date, and retained earning at that time was so much. As at retained earnings balance 140. Profit for the period is so much. Sale of inventory from associate joint venture investor in the current period. Another example. Now, so just adding, this is the scenario and one transaction in adding. During 2016-17 period, B Limited sold 5,000 worth of inventory to S. That means upstream, not the downstream. B is selling to the S. These items had previously cost B 3,000. All the items remain unsold by the investor at 30th June 2017. So you will realize now the cost of this much of material inventory selling to S by B at 5,000, and all the items not remaining unsold. So thereby unrealized profit is the total profit the between cost and the selling price. 2,000. 2,000 is the unrealized profit. Is it clear? So we will do the calculation now. Having understood this particular scenario, what scenario is clear? 25% acquisition. Retained earning at the acquisition date is so much. Retained earning 1 year later, 140. The profit recorded for the 2016 and 17, the next year, the current year is 30,000. So what is this 140, 100 minus? So if you want, I will draw the timeline. Timeline is important when drawing picture accounting. This timeline is important. Now we are here. The acquisition date is first. When the acquisition date? Yes, 1/7/2015. Agree? 1/7/2015. I am just putting the 50. That is the acquisition date. Is it clear? Okay. At that time, the retained earning is 100. That is 100,000. Okay. 1 year, your accounting period ends with, as per the question, ending 30th June 2000. 30th June. එතකොට මෙතන ඉවර වෙන්නේ කවදද? 30th 6 එම නේද? 2016. Is it clear? One financial year. It's not one financial year. Yeah, one financial year. The second financial year is 30th June 2017. And here the retained earning year given, and here also retained earnings given. 140. And also you can remember the profit for the period is given. What is the profit for the period? 30,000. Is it clear? Profit for the period. What is the difference between 140 and 100 then? What is the difference between 140 and 100? 140 and 100 is the profit you raise during this period. That is 40,000. You take your portion, that is 25%, 10,000. Okay. So you acquire the significant influence at this point, and this is called post-acquisition profit. In the first year, 140 minus 140, take 10%, and by this amount, you have to increase the value of the investment, And next year, profit for the period is given 30,000. That is the profit, 30,000. And this particular year, there was a special transaction, upstream transaction. B, the investee has sold 3,000 worth of goods to the investor for 5,000. So thereby unrealized profit is 2,000. And you know, tax matter is there, 1 minus 30, 1,400. You have to unrealized profit, you have to remove it from the financial statement. So you deduct it, and from this 28,600, you take 25,000. So that is the adjustment, that is the calculation. So journal entry would be as follows. This 10,000 you have to increase the investment. Here the investment value is not given, of course. Investment in associate in joint venture, debit 10,000. Retained earning of the consolidated financial statement, 10,000. Investment in joint venture, that is the portion of current year profit, debit, and P&L, profit and loss account, credit. This 10,000 we are not crediting to the profit and loss because we have already prepared the financial statement. This is the current year profit. Current year profit portion we credit to the share of profit and loss under the heading of this. Is it okay? If the investor does not prepare consolidated financial statement, the entries are recorded in the record investor. The only entry made at 30th June 2017 is the same as the secondary entry above. If the investor does not prepare the consolidated financial, the investor is only preparing individual accounts, then at that time your journal entry would be only this. Okay. I think I have to clear one thing here. You don't misunderstand here. We have to very clearly understand what I'm going to explain you now. Now what I want to communicate to you is that this is the consolidated journal entry. This is the journal entry if not prepared consolidated financial statement. If not prepared consolidated, that means you have only one associate. If you have one associate, no subsidiaries, you don't prepare the consolidated financial statement. If you have only associates, no subsidiaries, no consolidated financial statement. If that is the case, this is the entry. But remember, in our Haley's report, we look at the balance sheet side. The investment value was the 2 years was same. I told it is the cost. That is a different story. Huh? The investor in the separate financial statement, investors separate financial statement, not the equity cost method. Investors consolidate financial statement, equity method. Investor does not prepare consolidate financial statements, but investor is having investments. Then what do? You prepare, but you prepare under equity. And both method equity. Here also equity, here also equity. You have to remember. But I will tell you why here only one journal entry, why here two journal entries. You have to remember these are consolidated financial statement entries. So these are nominal entries. These are nominal. What do you have nominal? Nominal means when you prepare the accounts, you just put entries in a piece of paper. Once your task is over, you put that piece of journal entries into the dustbin. This is not recorded in any ledger account of the investor. This is only a consolidated worksheet here. Consolidated worksheet. If you read it, you will get it. Consolidate worksheets. But when you when you are not preparing consolidated financial statements, each year you are updating your investment balance according to the equity method. Each year you are updating. So thereby, if you are updating your ledgers each year, so you have to update only the current year. What I want to communicate to you is that under both methods, value of the equity under investee, the investment of the investee, same. But here you put two journal entries, here you put one journal entry. Why you are putting one journal entry here? Because each year in the investor's books, you are, when you prepare the, combine the investor and the associate accounts, not the consolidate, you update the ledger. That is the story. Okay. Otherwise, there is no specific reason. Huh? I explain why there is two journal entry and one journal entry. Okay. Shall we go to the next one? Now, here in this case, you have to remember the transaction, intercompany transaction was upward, upstream, from associate to investor. Sale of inventory from investor to an associate. Now, this one is from investor to associate, that is downstream. Okay. If it is the downstream, what is the answer here? Details are the same as in example, except the S limited sales to the inventory to the B limited. The calculation and journal entries are exactly the same as in example one. The follow of the transaction with the upstream or down does not affect the counting for the transactions. Same journal entry, no difference. Okay. Okay. Sale inventory of current period part remaining unsold. This case, all remain unsold. Now this is part remain unsold. During 2016-17, 5,000 worth of inventory to S. That is associate is selling to the investor. These items have previously cost 3,000. Half of the items remain unsold. Half of the items unsold at 30th June 2017. The increase to the investment account is calculated in a similar way to the example here, but what you have to do is same calculation, 10% you can remember from the retained earning. And here you have to remember 5,000, 3,000 minus profit is 2,000, but you have to remember half of the goods unsold, so thereby from that profit you have to take 50% as unrealized. That's why here you get 1,000 rupees, but tax matter is always coming, and 30,000 you deduct 700, so you get this one, 20% is that is it clear? So journal entries would be here in the consolidated financial statement, and individual journal entries, I think no need of, if you want the individual, those if not prepared consolidated financial statement, same journal entry, but figures will change. Is it clear? Okay. Then a sale of in the previous period. Now first example, unsold, remain fully. Second example, part unsold, then you take the unrealized profit only for that unsold items and take your proportionate, investors proportionate. And here, during 2016, S5000 inventory, same thing. Here the S is selling, that means the investor is selling to the investee These items had previously cost 3,000. All the items remain unsold, and these were eventually sold in the following period. That means now you have to remember this very clearly. This period we consider 2016-17. Now in this example, what happened here is we consider the 2015-16, and our current year is not 2015-16. Our current year is 2016 and 17. Now previous year unrealized profit, this year will realize. How do you account for? Now, last year unrealized profit of 2000. Here, I think these all you can understand. 140 and 100, you know what it is. This is the acquisition date retained earning. This is the 1 year later, that is the first year end retained earnings. The difference is so much of profit you generated during the 2015-16. So unrealized profit adjustment is 1,400 and 25% share. Okay, 25% share. Then 2016 and 17 period, 2016 and 17 period, 30,000, and you have to remember the last year unrealized profit. This year you will get it realized. So thereby 1,400, and altogether 31,400 and 7,850. Okay. Okay. So you can understand that scenario. Then the journal entry would be like this: invention in associate joint venture, debit, and retained earning credit. That is this amount. The net proportion of 25, the portion of 25%. How do you get it? The profit for the first year is 40,000. How do you get it? Beginning retain, end retain, the difference, and unrealized profit fully, because we assume that all the items remain unsold. Unrealized profit portion is after tax 1,400. You deduct it. This is the profit of the investee, and you take out of from this you take 25%. So you increase the investment by that amount and credited to the retained earning. In the second year, 30,000, you add back the unrealized profit, because this year it is you get it realized. So thereby you are adding it, and journal entry would be investment account so much debit and the share of profit, associate profit credit. If the investor does not prepare consolidate, the first of the above entries is recorded in the accounts of the investor 30th, except that the credit made share of profit associate, and the second entry is part as okay. Now, what this para says that if the investor does not prepare consolidate financial statement, as I told you, what they put is they are recording their profit share each year, not like consolidation worksheets. So thereby what they do is the first journal entry, this journal entry they are putting in the respective year. That's what it says. They are putting the first journal entry in this year, but they are not crediting to the retained earning. Where to credit? They credit to the share of profit or loss associate. At that time they record, and second journal entry also will be recorded in the 2017 year. That's what it says. Okay, sale of depreciable non-current assets. Now we have considered the inventory from different perspective. We have considered full remain, part remain, and previous year unrealized profit, second year realized. Three examples, three scenarios. Now we will consider sale of depreciable non-current assets. In this case, how do you treat it? Okay, we will see the example. The previous example scenario is common. The acquisition of 25%, acquisition date, all those common. Right, 1st July 2015, Basel Limited sold. Basel Limited, that is the investee, upstream sold item plant to S Limited, 80,000. The carrying amount of the assets on that this date, Basel Limited record 3,000. So you will see there is a gap, 5,000. The plant had a remaining useful life of 5 years. What happened? 5 years depreciation impact. Okay, we'll see. 1st July, beginning of the acquisition date really, I think. Yes, 2015-16. Change in the retained earnings, you can remember 40,000. You know how to get the 14,000. 100 minus 140, opening retained earning and the closing returning of the first year. You can remember this 40,000. Always same this, 40,000 here. Can you remember? Right. And unrealized after tax profit on sale of plants, you know, the profit is 5,000. Always tax matter is there, net of tax. So thereby 3,500. This 5,000 is unrealized after tax profit. Okay. Unrealized profit. And also realized profit on sale of plants. What is realized? What is realized? You have to understand it. Now, you know, when you think about intercompany transactions, intercompany, 3,000 worth of property, plant, equipment, whatever, the depreciable asset is transferred to the investor. So when investor is getting that, it is recorded at 8,000. So, you know, it's 5,000 overstated assets in the books of the investor. So thereby investor is really, you know, depreciating in such a manner. So thereby what we have to do is this this is the unrealized total profit. That this unrealized total profit is over 5 years. And this year realize 7,000. How do you get it? From this 3,500 divide by 5, just like depreciation. You consider it as realized and add back to the profit. 40,000 full unrealized profit and add back 1/4. 1/4 means the depreciation of the particular year. So thereby investor's share is 9,300. How do you put the that is 2015 and 16 period data. When you put 2016 and 17 data, you start with 30,000. You know the 30,000 is the profit for the second year. And this year, second year, unrealized profit, you will get realized another 700. How do you get it? 3,500 minus 1/5. So thereby that is the investor's chance. Okay, I think journal entries are common. No need of explaining these journal entries. Then the payment interest, plus 10,000 and interest 10,000. Although the profit includes the interest expense from this transaction, no adjustment is because revenue and expenses is assumed to be realized. Profits are considered to be unrealized only when there remains in assets and associate transferred as a profit or loss from them. Now you have to remember, when associate and the investee as investor really uh, do some financing transaction, some borrowing, just because of this borrowing, interest rate is there. But remember, we don't make any adjustment for interest. Earlier also, yesterday also, I highlighted this matter. So thereby payment of interest not being considered when doing this particular intercompany transactions. Then the transaction between associate, when you take the transaction between associate, of course, what you do is you take the, you know, the just what do you call multiplication. Assume X limited on 25% shares of D limited as well as 40% of obey. Then now S is having two associates. One is B and other one is O. Where transaction occur between two associates, when the transaction taken place between two associates, you get the proportional adjustments, that is 14 to 25, which is the product of the ownership interest in associate 10%. So how do you do it? Just look at this. In the current period, B limited sold inventory to O limited. That means B is one associate, O also another associate. After tax profit is 100 rupees. The inventory remained unsold at the end of the period. Inventory remained unsold after tax profit. Inventory unrealized profit is 100 rupees. So recorded profit is here, it's given 1000 rupees. Here 1000 rupees recorded profit. And unrealized profit is 100. From this 100, what you have to do is you take 10%. 10% means 25% into 40%, and that is the unrealized profit. So thereby 990 is the profit for the particular what do you call B recorded profit. And so you take 10%, 25% of this, that is 247.5. That you know how to put the double entry. No need of putting here the joint investment in associate B and not the O. Is it clear? Okay. Share of losses of the associate. Here basically what we focus on, if the particular associate is continuously making losses, what will happen? So I am just putting you the example, then you can understand what it is. Now just look at it, this. Okay, example. So what is our heading? Heading is this, share of losses of the associate. Of course, if you read, you get the idea, but by using this example, I'm just giving you the core message. 1st July 2011, B acquired 25% shares of Crumpet Limited, 100. At the date, equity of Limited was 40, with the identifiable assets and liabilities being measured at fair value. Now, when you look at here, B Limited acquired 25% of for 100,000. At the date acquisition, Trump Limited was 400. Equity, all the assets at fair value. Okay, so we will see. Can you calculate the? We can calculate the goodwill if you want, but here we'll see the answer. The data acquisition date is 2011 July. So thereby you get two financial year 2011-12, financial year 2012-13, financial year 2013-14, 14-15, and 15-16. Profit of the associate. Associate mean T 20,000, loss 20,000, 250 loss, and 16 and 200. I think here it has to be not 20,000, it has to be 200. There's a small mistake. What I'm trying to tell you is that very clearly this has to be what do you call not you have to add one more here. The figure has to be, it's a typing mistake, 200,000. Is it clear? It has to be not the 20,000. It has to be 200,000. Then only you get 50,000. I'll explain it. Okay. Share of profit, of course, you know, 20,000. You take 25%. That is 1/4. 5,000. Here 1/4 is 50 within bracket. Why within bracket? Because it's a loss. Here 250, 1/4 is 62,500 within bracket because it's a loss. 16,000, 4,000, 20,000, and 5,000. So that is the share of the investor. Is it clear? Cumulative share. Cumulative share means first year acquisition you get 5,000. That 5,000. Second year, at the second year cumulative is, this is negative, no? With this 500, answer is 45. This, then this plus this, something like this. This plus this, you get this, right? This plus this, you get this. This plus this, you get this. Still clear? Cumulative share. So what is the initial amount? Initial investment? 100,000. So thereby, what is the equity method account at the end of the 2012 June 30th? 105. How do you get the 105? This 100 plus 5. How do you get the 55? 55 is this 100 plus this 50 and minus 50. This 5,050. Oh, meaning is that 100,000 minus 45. You get 55. Then, of course, next year, of course, you don't have an asset account. No? You have a minus figure. Here, 100, 107.5. So, thereby 7,500 minus. 7,500 minus. And here, 100, 103,500, 3,500 minus. But we are not really, what do you call, we are not putting those values. So what you do is 100 minus 98,500, positive figure. We don't record here anything. That's the idea. When there are losses. So the journal entries, I think no need of explaining journal entries. You will realize June 12, that is the first financial year, 5,000 debit investment account, share of profit credit. Okay. In 2013, you are making a loss. So thereby, share of profit and loss in associate and joint venture debit because it's a loss. The profit we credited, loss we, it has to be, yes, loss we debited, and retain earning 5,000 and investment in associate is 45,000, which is the current year profit. This is retain profit. Likewise, here 55 loss and retain earning 45 and 100,000. Here retain earning 10,000, 100,000, here 100,000. Here 100,000, 95,000, 1,500. That is the logic. Can you understand? Here 55,000. Investment has to be 55,000. Return earning 45,000 and investment in associate 100,000. So investment account will be, uh, 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 vanish. Then 100,000, 100,000. Return earning 100,000 debited and investment in associate joint venture credited. Share of profit 1,500. So that could be the journal entry for, loss making entities. Okay, with this, what I have done is I have just completed the investment in associate and joint venture equity method. So hope that you will read this chapter and understand the relevant journal entries. If you have any question, I can answer. Otherwise, I will stop and I will uploaded the recording. Yesterday, I just I went home and because it will take little time to record, save in the in my computer. So today one and yesterday's one, I will upload if you want. Any question? Right. Thank you very much for joining with me. Then we will meet, I think, again tomorrow. We will just discuss the due diligence and finish it off. Sandharvan sir asked me not to take, I don't know, he will take another revision series maybe, but from just tomorrow onwards, to tomorrow, so my part is, I'm going to finish my part tomorrow. Thank you. Okay. Can you please upload the, yes, I will upload. Last week one, I will check it. Recording is available. Yes. Oh, I will. Okay, I will do. Don't worry. Don't worry. I will upload. Thank you very much.